We start off with the banks near their judgment day. The CEOs of the big banks surviving a grilling on the Hill as they gear up for earnings at the end of the week. JP Morgan will kick things off on Friday. It is the worst performing of the big banks so far this year, up only 8%. Citigroup, Goldman Sachs, Morgan Stanley, they're all up double digits. But, of course, the sector has been mostly dead money for the last year. So will this quarter's earnings be the catalyst to set the financials on fire, Guy?
Hi, Mel. Well, I'd like to think the answer to that question is yes. I just don't see it happening. For the life of me, I don't understand how all of a sudden you get this reacceleration in earnings for the banks, and they're going to be off to the races. Now, I think earnings will be okay. Earnings have been fine. J.P. Morgan's earnings, quite frankly, have been very good. But what's already priced in? And when you're getting towards 1.8 times price to tangible book in terms of a J.P. Morgan, I say maybe it's just a tad ahead of itself. You have to ask yourself the following question. Why is Citibank trading effectively tangible book? Why is Deutsche Bank in Europe, despite this whole Commerce Bank thing, continue to go down? I still think the banking woes in Europe at a certain point manifest themselves here.
Resident Bank Bull, what do you say?
You've got another reason, Guy, to really be angry with the Fed. It's negative interest rates that I think are killing the global central banks. It's certainly killing the European banks. For someone that's been constructive, I'm long J.P. Morgan, I'm long Citibank, I'm long Bank of America. And I can be long with those valuations with a capital deployment approach now that I think is actually investor friendly, with a balance sheet that's fantastic, with a business model that I think is conservative and not reckless. But is there going to be anything extraordinary in this quarter's numbers? No. And in fact, I think you're going to see downward tick in terms of their net interest margins. You're going to see downward tick in terms of sales and trading. You're going to see a downward tick probably in mortgage originations. But nonetheless, J.P. Morgan continues to print record profits. Record profits.
You brought up a good point that there's nothing special about the banks. They're kind of safety type of thing. They're utilities. That's effectively what they become, is utilities. So they should trade at 1 times book. So if you look at the ones that aren't trading at 1 times book, it's a JP Morgan. The ones that are, it's a Citibank. Citibank might even be a little bit below that. So that's probably why it's up more than the others, or one of the leaders this year. The only thing, in my view, that is going to change this if you get a steeper yield curve, and that can happen one of two ways. The economy accelerates, which it doesn't look like it's necessarily going to do, or the Fed decides to steepen the yield curve with their balance sheet. So to me, that's the bet you're making if you're buying banks right now.
There's absolutely nothing that excites me about the banks right now. It's really, really difficult for them to make money with either a flat or an inverted yield curve. We do own J.P. Morgan. I think J.P. Morgan's best of breed. Their ROE is really head and shoulders above the rest of their peers. And you get some good revenue diversification from them in the AUM revenues that they're collecting, as well as the investment banking fees as well.
I was talking to Mike Mayo this morning on Squawk Box.
Love Mike Mayo. He's a fantastic analyst.
For the first time, he said that he's bullish all 5 banks that he covers, all the 5 major banks.
Mike, who's been very negative, by the way, let's be clear, but I think he's been very bullish for the last couple of years.
For a while. And I said, well, you can make the same argument over and over and over again, quarter after quarter, for the past few quarters at the very least, in terms of the strength of their balance sheet, the growth of the economy in the U.S., et cetera. But what is the catalyst to get these stocks moving higher? And he said, interestingly, every few years, all they have to do is not mess up, and then there will be a re-rating of these bank shares. Is it as simple as that? They don't mess up.
Haven't they been not messing up, though, for the last couple of years? Really? I would make an argument that that's...
Well, wait a second. Goldman Sachs absolutely messed up over the last 6 to 9 months.
With the IMDb and all.
You can make an argument that Wells Fargo, all they've been doing for the last 2 years, is messing up. So some have
Although they're trading at a premium.
And they are, right? So
I take my statement back.
No,
you're actually right. Now that I think about it, those are 2 poster children for mess-ups. But I do think, referencing what Brian said about the banks kind of slow and steady like utilities. By the way, utilities at all-time highs. So you could make an argument that they should be keeping pace. But really, what are they doing? What are they there to do? And they're involved in transactions. They're collecting fees. And that predictability to their earnings model, to me, even with a lot of disruption, and maybe that's it. At the end of the day, every industry is getting disrupted. You can make an argument that technology and fintech and all these things that are disrupting financials, they're as poorly positioned as anybody.
Yeah, so, if the banks aren't really moving, why not just grab some of the preferreds? You can pocket a decent yield at this point. At least you're going to collect that dividend. So I think there's potentially some opportunity with the preferreds.
Or if you believe that banks are really being disrupted, do you go to the flip side of who is disrupting the banks, which stocks are disrupting the banks. Maybe you look at a Square.
PayPal.
Or
maybe you look at-
cryptocurrencies.
For sure.
You know I'm going to go with
Clearly you're
Bitcoin.
gonna go
You know
there.
I'm going with
Clearly
Bitcoin
you're
on that.
gonna-
But
a whole segment on that later.
who is ripe to be disrupted by cryptocurrencies? It's the banks. So eventually they're going to be a problem.
But that's not a pairs trade.
That's not a pairs trade. I mean, you could. Some people are advocating put that on, shorting the banks, long Bitcoin. BK would not advise that. Just be long Bitcoin.
I guess the question we should ask is, and a question I think you were sort of asking is, will the banks set the tone for the rest of the earnings season? And
I wasn't, but that's an excellent
It's a
question
great
to ask,
question,
and I'm
guys.
glad
Would you
that
rather?
you've asked the question.
Fantastic.
Trade
It's
it.
an excellent
I wish I
question
had an
to
answer.
ask.
No, I don't. I think the answer is probably no. I don't think the bank's earnings. I think J.P. Morgan's earnings will be outstanding. I think Goldman Sachs' earnings will be probably middle of the road. And I think what we've seen historically, J.P. Morgan trading higher and Goldman Sachs trading lower, is probably going to be the norm. With that said, in terms of earnings season across the board, you know, we've had the conversation. I do think we're on the brink of an earnings recession. I think people are setting themselves up for a lot of disappointment as we go through the next couple of weeks.
I don't think the banks have set the tone for earnings
No.
season for
I-
years.
that's why I'm not-
For
No, I'd
years
be
at this
shocked if
point.
they
Since the
did. I'd be
cooking
absolutely
prices,
shocked.
I think
maybe.
industrials would really do a better job of doing that. I mean, it's got the highest R squared of all the sectors as it relates to the market. So I think that's
Correlation, R squared.
Yeah.
What I'll say about the banks is what we've seen in the last 2 quarters, maybe 2 to 3 quarters, is actually the banks come out of the gates and actually pleasantly beat in some cases by a significant amount. Shares don't do anything. In fact, they kind of disappoint. They don't hold on to a rally. And then banks actually have rallied kind of 2 weeks and 3 weeks into earnings season, as the rest of the earnings have largely been very beneficial to their cause. So is that going to happen? It doesn't sound like there's a lot of optimism, but I would go back to, again, market positioning. The thing that bothers me about where the market is going into this earnings season, bull-bear spreads, whatever you want to look at, sentiment is very, very bullish. And that's for the market overall. I don't think sentiment going into earnings is bullish in terms of what you're going to hear in terms of guidance for second quarter and the rest of the year. So because of that, I still think that there could be a risk to upside responses from a lot of these companies.
What sector is going to be the tell for you?
For me, you're going to have to go with the industrials or tech sector, right? That's what everybody cares about right now. The banks, you can trade them. You want to trade them on a breakout, knock yourself out. But it's going to be what both tech and industrials together do for this earnings season. Without that support, at these levels, to me, the market is getting riskier the higher we go, right? I understand it's being built on the fact that you have loose money from central banks, but at some point, fundamentals do start to matter. So the higher we go, the little more scared BK gets.
There is an argument that is being made that people in general are underweight the markets. Do you feel like that's the same for the bank sector? I feel like that's one of those sectors that people point to and say value, value, value. And yet the bull case for banks was a bull case that they were making a year ago. And what's happened since then?
I think it's been hard to be underweight banks, even though it's been easy to say, what's going to be the catalyst in banks. So, no, my sense is I think people are generally at equal weight in banks because the banks really have been running a pretty steady course of giving earnings, giving guidance, giving 2 to 3% dividends, which now over the last kind of 4 years is kind of a building dividend base, is why I think a lot of people own these banks just to be in them.
Maxine Waters.
Great interview with Wilford Frost earlier this afternoon.
Just moments ago, in fact. Very fiery, as chairwoman of the House Financial Services Committee. And I bring her up and Alexandria Ocasio-Cortez because has the environment at all, even on the margins, changed for banks? I mean, if we had believed that deregulation was the wind at the back of the banks, could incrementally there be some tougher times ahead for the banks?
Is there existential risk with the banks now that there's new sheriffs in town in terms
Even
of
just dragging them up on Capitol Hill for 7 hours at a time?
I believe absolutely that's the case. I don't think the rhetoric's going to get any better. I think it's just going to get worse. So that could be absolutely a headwind for banks that we haven't talked about, but we probably should start talking about.
Yeah, I think that's fair, especially because the opposite is really what happened, right? Remember, on the election, you had essentially the triple clean sweep across the board, which included the House. And although nothing really happened for banks, they continued through their C-card tests and stress tests. What you saw is essentially the bullseye on their back was removed. And that's why banks outperformed out of the gate. So it's a fair point, Melissa. And I think in the environment we have going into elections, there's a lot of people that think that the big banks, especially the big banks, really didn't pay their just due for what happened in the financial crisis. And a lot of these are different CEOs, but it doesn't mean that the banks themselves aren't still considered villains.